Alright, so welcome to Market Forecast and Opportunities 2017, Part 2. I'm Adam Khoo. If you have not watched Part 1, do watch Part 1. And before we continue, once again, pause the video and read the risk disclaimer. Um, Essence of it is I'm not a licensed financial advisor. I'm just a personal investor and trader who makes pretty good money. I'm just here to share my insight with you purely for educational purposes. Alright, great. So in the last video, I talked about what happened in 2016 and what I got right, what I may not have gotten right. So here's my forecast and outlook for 2017, the themes, and how do we profit from it. First of all, taking a look at the global economy. The global economy is indeed picking up from the previous recession. And one of the reasons is because economic indicators have been showing upticks since the second half of 2016. The Global Manufacturing Purchasing Index, as you can see on the chart over here, has continued to rise to a 27-month high from November 2016. And the OECD has upgraded its 2017 forecast for global economic growth, specifically in countries like the US, Europe, Japan, and many other countries. So in terms of the macroeconomics, it looks positive. What's really important is to also look at market valuations. Are markets expensive, or are they cheap, or are they fairly valued? One way to judge it is by looking at the market PE ratio. What does it really mean? So if you look at markets, you find that markets go through booms and busts, right? Booms and busts, booms and busts, kind of like a cycle, right? And basically, when the market is at the top of the cycle, when it's like in a bubble, right, overvalued, prices of stocks are really high relative to earnings. So PE tends to be very high at the top of the cycle. After a crash, after a recession, when prices are depressed, they are very low. Prices are very low relative to earnings. So PE tends to be really low at the bottom of the cycle. So what is considered a high and low? Well, it depends on historical benchmarks. If you look at the S&P 500, the US market, for the last 130 years, the lowest PE that was reached during previous crisis was 5. All right. In fact, during the subprime mortgage crisis back in 2008 to 2009, at the bottom of the market, the PE was 5. And that's how I knew to begin to accumulate stocks. Now, how high does the market usually go before it hits the top and begins to come down? Well, on average, it's been about 25 to 26 PE. But of course, having said that, there were certain times when the market PE went as high as 46. This was during the dot-com bubble of the year 2000, when it was extremely expensive and overbought. Okay. Now, historically, the 100-year average of the PE of the market has been about 15. But more recently, in the last 10 years or so, it has been slightly higher at about 16 PE. So what this means is that if you look at the US market, if the PE is at 15 to 16, it's fairly valued. It's not expensive, it's not cheap. If it's above 15 to 16, it's overvalued, and at 26, it's extremely expensive. Having said that, it can go even as high as 46 historically, right? When the market is below 15 to 16, it's undervalued, and at 5, it's the lowest, it's the cheapest it's ever been. So let's look at the various markets and see which are the ones that are expensive and cheap based on this measure. If you take a look at the different markets over here and the PE ratio based on the last 12 months of earnings, you can see the S&P 500 is at 21.32, way above 15 to 16 PE, and the Dow is at 18.96. Okay. The Jakarta Composite Index, after a really good run in 2016, stands at 24.13. So these three markets are definitely not cheap. They are overvalued. They are above fair value. Okay. Next, what's at fair value? Well, if you look at the Malaysian market, it's at 16.78, and the Shanghai Composite Index is at 17.97. Bear in mind that the Shanghai or rather the China market has a higher growth than the US market. The US grows at about what, 2-3% a year, whereas China grows at 6% a year on average. So we expect that with higher growth, it commands a higher price earnings multiple. So for high growth countries like China, I would say the average PE would be somewhere around 18 to 19. So that puts the current PE of 17.97 as at fair value. If you look at Singapore, the STI is at 12.54, and the Hong Kong Hang Seng is at 12.49, and that's really undervalued, that's really cheap. Now, on the last video, I did mention that in making investment decisions, we look at two things. First, we look at valuations. Are things cheap or expensive? The second thing is we look at trends. Is the market on an uptrend or on a downtrend? Because if the market's on a downtrend, even if something is cheap, cheap can get cheaper and low can get lower. So it doesn't mean that just because it's cheap, you're going to buy it. You have to wait for a clear uptrend. At the same time, if something is overvalued and it's expensive, it doesn't mean you can't make money anymore. Because if it's still on an uptrend, expensive can become even more expensive. It can become even more overvalued. You just have to be a bit more cautious in entering and be ready to exit once trends change. So once we have now looked at valuation, let's look at the individual market trends of the markets. This is a chart of the S&P 500 PE ratio, historical value over the last, let's see how many years, 2003 to current right now. So it's about 12 years, that's right. Okay, so you can see that in the last 12 years, the lowest PE that was reached was about 10. Okay, and the highest PE was about 20, 23 thereabouts. And the average mean PE, 16.4. So that's the band. Really expensive, really cheap. Center of the cycle. So again, currently, the market P is about 20 to 21, somewhere over here. So again, what does it tell us? We're above fair value, but we may still have some more room to run before we get really at the top of the cycle. Okay. Now, looking at specific market trends. This is the S&P 500. And you can see the S&P, the US market, is on a clear uptrend. And we define uptrends by looking at the moving averages. So you can see the 50 moving average above the 150 moving average, and they're both sloping up. And that indicates a very clear uptrend, especially when the price is above the moving averages. Okay, this line you see here is a 20 exponential moving average that measures the short-term trend. So when the price is above the 20 EMA, it tells us that in the short term, the trend is up. And the 5150 moving average tells us the medium term trend, which is also up. So in other words, we're on a short term uptrend and a medium term uptrend. So it's still a very clear uptrend for the US market. It may be expensive, but based on trend analysis, you'll probably go quite a bit higher for now. This is the Jakarta Composite Index. And again, it's not cheap, but it's on a clear uptrend again. You can see the 50s above the 150, all right? And you can see there is a bit of resistance over here, okay? Resistance level over here. Currently, right now, the 50 is still above the 150. Even if the 50 crosses below the 150, the 150 is still sloping up. So that indicates, again, a very clear uptrend. Remember that we can't predict how long a trend will last. We can't predict the future. We can only see where the trend is right now. So based on current trend, we can still go along the US market and the Jakarta Composite Index, knowing well that it is expensive, but it could go a bit higher in the short term. But the moment the 50 crosses below the 150 moving average, and the moment both moving average start to slope down, that's when we have to exit in case it's the beginning of a downtrend. How about the Malaysian market? The Malaysian market doesn't look that exciting, although it's fairly valued. And one of the reasons is because it's currently in a consolidation pattern. And if you've looked at some of my previous videos, I've mentioned that in a consolidation pattern, you ignore the moving averages. Okay, you just look at the support and resistance level. So you can see the support level is somewhere around 1615 with a resistance level at 1725. So it seems like it's in this range bound market, for the Malaysian market. The Shanghai market looks a bit more exciting. Why? It's fairly priced and it just crossed into an uptrend. After you see this big sell-off in January of last year, after that sell-off, it began to reverse trend and it began making higher highs, as you can see, higher highs over here, and higher lows, which is a very clear indication of an uptrend, and it's confirmed by the 50 moving average, blue line, crossing above the 150 moving average, and both moving averages have changed slope from sloping down to now sloping up. So it's a really clear uptrend, and so for now I'm bullish on the Shanghai market because it's fairly priced, it's on a very clear uptrend. I'll go along on this right now. How about the Hong Kong Hang Seng? Well, Hong Kong Hang Seng, again, it's undervalued, it's cheap, and it is on an uptrend. All right, you can see the 50 crossing above the 150. So it began its uptrend pattern somewhere around here. It's gone up. Now, it's currently on a short-term counter downtrend, as you can see over here. So this is a short-term downtrend, but the medium-term trend still remains up. So you can see a counter trend line resistance over here, trend line resistance level. And the great news is that the price has just broken above that counter trend line resistance. The 50 remains above the 150, and I would say at this point of time it looks like it is still going on an uptrend. So again, I'm bullish on the Hang Seng as well. Finally, the Singapore market. Singapore market is cheap, it's undervalued, and it just reversed into an uptrend as well, somewhere over here. After being on a downtrend, the 50 crossed above the 150, and it went into a bit of a consolidation for most of 2016, with clear resistance at 2950 over there. Okay, but recently it broke above that resistance level at 2970, so that's a bullish sign when the price breaks above the resistance. Potential supply was taken out, and looks like we could be looking at some potential upside on the Singapore market. Okay, so let's look specifically now at the US market and my specific outlook for 2017. The US market, as I've mentioned a few times before, is expensive, but bullish momentum is still strong and likely to push prices higher in the short term. So, what is causing this really bullishness in the market? Well, a few things. Number one, positive economic data. Number two, the Fed tightening cycle. And what that means is this. Historically, when the Federal Reserve increases interest rates, sure, in the short term, the market tends to have a knee-jerk reaction going down when interest rates go up. But in the medium to long term, as the Fed raises interest rates, it means it signals a strengthening economy. And hence, the stock market tends to go up as interest rates go up in the medium to long term. Next, because of the new Republican government coming in, it's going to be really pro-business. So there's anticipation of, again, deregulation of the financial sector, of banks, more infrastructure spending, and deregulation of the healthcare sector. So all this means, and plus lower taxes, and all this creates more consumption demand and higher prices for now. What are some of the positive economic data? First of all, outperformance of cyclical areas of the economy, like financials, industrials, energy. And all these signals investor confidence in economic growth. Next, the economy has also shown steady improvement since 2016, with quarterly annualized GDP growth up 0.8% in the first quarter, up to 1.4% in the second quarter, and 3.2% in the third quarter, accelerating GDP growth. These are the specific US home values, as you can see, beginning to rise. Makes Americans feel more wealthy, so they're willing to spend more. It's a wealth effect of home prices rising. Strong labor market data. Okay, jobless claims remain at a historical low. New jobs have been added in November, 178,000 new non-farm payroll jobs, and the unemployment rate has declined to a 9-year low to 4.6%. So charts over here, you can see unemployment rate going down, hourly wages rising, home prices rising. Really bullish, positive economic data. And the current consensus is for the S&P 500 companies to deliver earnings per share of 12% growth for 2017. Now, specifically, which sectors are likely to outperform and do well, and we can put our money in those sectors. First, healthcare, mainly coming from innovation breakthroughs, plus an aging population in the developed world should drive up prices in the healthcare sector. Next, technology. Specifically, one of the big themes in technology is cybersecurity. So you could invest in cybersecurity companies through the cybersecurity ETF. And the ETF is known as HACK, hack. We'll look at a chart in a short while. Next, financials. Sure, banks have rallied quite a bit, but banks' earnings growth continue to look like they're going to continue to benefit from a high interest rate cycle. So I'm looking for banks to go higher. Industrials would also benefit from increased infrastructure investment and spending. Specifically, we call it Industry 4.0, which is robotics, 3D printing, and big data. So I'm a firm believer in the next 10 years, robots are going to take over a lot of jobs and a big part of our lives. And that's why I'm going to put my money in the robotics industry. And again, you can look at the robotics ETF, known as ROBO, R-O-B-O, to take advantage of that. We'll look at the chart in a short while. Finally, energy. Oil prices have stabilized. In fact, they've rallied 85% and look like they're stabilizing from here. Plus, improved cost structures. Oil and gas companies have been cutting costs a lot. So now with oil prices coming back, it should drive modest earnings growth in the oil and gas sector, energy sector. Sectors likely to not do as well would be, again, defensive equity sectors. See, when the economy is doing really well, cyclical stocks outperform, defensive stocks underperform. So defensive stocks are stocks like US telecommunications, utilities, and they tend to pay high dividends. So again, when interest rates rise, dividend stocks and yielding bonds tend to go down in price. All right? So let's take a look at some charts. So this chart shows you the different sectors that would probably outperform. Okay, and how could you or how can I invest, or how do I invest in these sectors? You could buy the individual stocks in finance or in energy, or you could just buy the whole sector by buying the ETF. So for example, for financials, the ETF is known as XLF. Technology is XLK, industrials is XLI, and healthcare is XLV. Energy, XLE. Specifically, like I mentioned, if you want to go into investing in the robotics industry, you could look at this ETF known as the Robo ETF. And you can see for the last year, it's been doing really well on a very clear uptrend. This is the cybersecurity ETF known as HACK, again on a very clear uptrend. So these are two great industries that look set to continue to go up in price. Next, let's look at currencies. Okay, I'm still really bullish on the US dollar, and I believe the US dollar will continue to appreciate against world currencies, especially against Asian currencies. For a very simple reason, rising interest rates. And the Fed is projected to raise rates 3 more times in 2017. From a technical perspective, you can see this is the US dollar versus the Sing dollar. Again, you can plot it against the pound as well, the pound dollar, or whatever it is, the euro dollar. And you can see again the 50 crossing above the 150, signaling a very clear uptrend for the US dollar versus the Sing. And I'm especially concerned with that because I'm from Singapore. So where are we in terms of the economic and stock market cycle? Let me just explain. Now, first of all, if you look at the economy and the stock market, they are measured by two different things. The economy is measured by GDP. The stock market is measured by stock prices. Now, the stock market leads the economy by 6 to 9 months. So we say the stock market is a leading indicator of the economy. So what it means is this: when stock prices go down into a downtrend, 6 to 9 months later, the economy will register a recession most of the time. Okay? When the stock market reverses into an uptrend, 6 to 9 months later, the economy will register economic growth. So if you want to make money, what do you look at? Do you look at the economy or GDP, or do you look at the stock market price trend? The answer is the stock market price trend because it is the leading indicator of the economy. So for example, you can see over here at the top. Now, let me go back in history. This was the year 2007. Okay, October 2007, the stock market was at a high at that point of time. When the financial crisis hit, the stock market began to go into a downtrend. Now you can see that when the stock market goes into a downtrend initially, what's happening to the economy? The economy, shown by the green line, is still going up. Why? Because the stock market moves first. The economy takes 6 to 9 months to react to that. Okay? So when the stock market is going down, the economy is still going up. All right? So the trouble is when people look at the market going down and they look at the economy and say, well, the economy is doing well, so let me invest money. What happens? That's right. They find that the market keeps going down and they're wondering how come they're losing money when the economy is doing well. Okay? Now, by the time the economy tops over here and GDP begins to contract, right, and people start to sell their investments, what happens? By that time, the stock market has already fallen by 75% to near the bottom. So if you wait for the economic GDP to make decisions, you sell too late. Does it make sense? Now, at the same time, in February 2009, the stock market had bottomed after the financial crisis. And it started to reverse into an uptrend in February 2009. Now, you can see that as the stock market goes up, the economy is still going down, right? Because the market moves first. So you have to watch the stock price trend in order to enter early. Now, some people think that I should only invest when the economy is recovering. Wrong. Because you can see that by the time the economy bottoms and by the time the economy recovers and you buy stocks, what's happening? You're buying near the high again. That's why most investors sell too late and buy too late, because they look at the economy, the fundamentals. What's more important is to look at the technicals of the price action of the market. So having said that, where are we right now in the market cycle? Now, if I could guess, approximately, I would say that we are somewhere over here in the market cycle. Okay? Why? Because in terms of GDP, we are beginning to see that GDP is beginning to pick up, is beginning to grow. All right? So we call that early recovery. Early recovery. So we are somewhere here. Right? So at the same time, where's the stock market? I mentioned that the stock market is somewhere over here. Let me draw it for you using this pen. Okay? So we are somewhere here right now. All right? Where the economy is staging an early recovery, but the stock market is already close to the high, because this is the center, this is the bottom, this is the high, right? So we are somewhere here. So what I'm saying is that, yes, the market is above its fair value at the center, okay? But it could still go higher for another, 6 months, a year or so, before it tops out, the bubble bursts, and the market will collapse again. All right, so do stay tuned to my future videos. I'll tell you when the market tops, I'll tell you when it's going to go down, and when I'm going to exit. All right, so for now, I'm going to tell you that we're expensive, but we're still going up, and we're at the late stage of the bull market and the early stage of the economic recovery. And that's how I read the stock market and economic cycle. Finally, let's look at gold. Now, if you read the news, some people will say gold is a great investment for the long term, and gold is used to hedge against uncertainty and all that. If you ask me, gold is a terrible, terrible long-term investment. It sucks as a long-term investment. If you bought gold 30 years ago and held it to today, you would have made an average of about 3.8% a year, which is a waste of time, okay? But of course, if you bought gold in the year 2000 at $250 and you sold gold at 2011 at 1,900, you would have made a killing, all right? So the thing about gold, like any commodity, is gold is very cyclical. You can't invest in it in the long term, but you can trade gold. What do I mean? That means you must watch the trends of gold. If you know how to buy when gold starts an uptrend, and sell when it starts a downtrend, you're going to make a lot of money on gold. At the same time, when gold's on a downtrend, you do not want to buy gold. You want to do a short sell on gold. And I'm here to tell you this, gold is on a current major downtrend. And it's been on a downtrend ever since 2011. You see, gold was on a 11-year bull market from the year 2000 to 2011. What makes gold go up? Gold goes up when a few things happen. Number one, gold goes up when interest rates are falling. Number two, when the US dollar, when currency is depreciating, and when the government is printing money. We call it quantitative easing. So all these things plus the financial crisis led to the surge of gold for 11 years. But what happened? In 2011, as you can see, this was the big bull market. In 2011 to 2012, the game changed. What happened was the US government stopped printing money. All right? They started raising interest rates and the US dollar started appreciating. And that's when gold started its downward move and is currently down 35% from its high of 1920. It's currently at $1,300 per troy ounce. So it's on a current downtrend, and based on historical cyclical data, gold goes on an uptrend for 11 to 12 years and goes on a downtrend for another 11 to 12 years. So currently, gold has been going down for the last 4 years, right? So we still have another 5 or 6 more years of potential downtrend on gold. So gold is something that I would personally not touch or invest in, okay? And if you look at the gold ETF known as the GLD, you can see also from the price trend that it's on a very clear downtrend with the 50 moving average below the 150. And although it may make a short-term rally, but the long-term trend of gold is definitely going down, in my opinion. Okay, so with that, let me just summarize the opportunities for 2017 and where I'm going to invest myself. Okay, first of all, I'm moderately bullish on US equities. I believe the US market will continue to go up. How long it'll go up, I don't know. So I'm going to watch the trends. And the moment the trend reverses down, I'm going to share it with you guys through my videos. So stay tuned to the future videos I'm going to create. All right. So keep riding the uptrend and exit once the trend reverses. Okay. If you are a value investor looking to buy cheap companies, forget it. It's not a value investing market. It's a momentum investing market right now. Next, specifically, which sectors are going to outperform? I'm looking at healthcare, energy, technology, financials, and industrials. Specifically, 2 industries: cybersecurity and robotics. Okay. Singapore market. In the long term, the Singapore market only grows at about 6%. So I'm not terribly excited by it, but it is cheap and it's on a clear uptrend. So I'm moderately bullish on the Singapore market as well. Shanghai and Hong Kong are cheap. They're on a clear uptrend. They've got high growth. I'm pretty bullish on that. Again, I'm bullish on the US dollar. I believe it'll continue to go up in the short to medium term against Asian currencies. And finally, I'm bearish on gold in the medium term. All right. So that are the options for 2017. I hope you enjoyed this video. If you've got questions, post them online and I'll do my best to answer your questions. This is Adam Khoo signing off. Take care and I'll see you soon.